Good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesday. It's always great to have you joining us early Wednesday mornings. From time to time, we all need a low risk, high liquidity income generating fund for clients to either park short term funds for income or to even de risk portfolios. Money market funds are nothing new to any of us, but are there possible advantages to, say, that of a call deposit at the bank? Today, we will have a specific look at the Cartesian BCI Money Market Fund. And here to give us an update on the fund as well as a global macro environment update is Anthea Gardner, Managing Partner at Cartesian Capital. Good morning, Anthea. How are you doing?
Good morning, Eugene. All good, sun shining. We're good in Joburg.
Yeah, fantastic to have you with us. First time on Boutiques on Wednesdays. You've been around in the asset management business for a very long time as well. So not new to the game, maybe new to the audience. And we're really looking forward to you sharing a little bit more about your business, what you do, update on the markets, and then specifically fixed income and your money market fund. Thanks, Anthea. You should be able
Thanks,
to
Eugene.
share
I'm
if
going
you
to share my screen with you. Right,
Yeah,
we're good to
perfect.
go.
Yes.
Yeah, as you mentioned, a lot of this audience hasn't met me yet. And I often get asked why the name Cartesian. We are in South Africa. We are level 1 BE company. I don't know, maybe we should have called ourselves Sawubona Capital or Pala Capital, managing the Red Couch Fund. But actually, I named Cartesian after the French philosopher and mathematician René Descartes, who you'll know because he said, or his kind of mantra is, I think, therefore I am. And his mathematical legacy is the XY axis, or as you can see in the right-hand side of your screen, you know that grid where you plot intercepts or your XY, 0, 0 is obviously the intercept. And then circled in the top right-hand corner of your screen, if you put those numbers into your Garmin or your Waze or whatever you use to navigate, that'll bring you straight to the front door of my office. And in fact, those are called Cartesian coordinates. And hopefully no one will forget that now. This is me, just very quickly, my background, very much investment banking, equity derivative structuring, and then a stint at the development bank where I picked up my fixed income investment skills. I'm clearly not a development banker, so now we're back to managing money. I'm often in the media, and I wrote a book if you're looking for me or mine and my team's opinions on the market. Eugene, I couldn't help myself when I saw this quote, because we're talking about fixed income, right? And the quote goes like this: you don't see TV channels devoted to fixed income investing the way you do with stocks. There aren't any, in inverted commas, gurus with pricey trading programs promising you eye-popping returns for fixed income trades. And you won't find many people at cocktail parties or, in the South African context, at braais, bragging about their latest bond investment. I often get asked, so which stock should I invest in? And if I say, well, I think you should buy the NGT 104, which is the Nedbank perpetual floating rate note, doesn't go down quite as well as how about some ShopRite shares? But it is an important asset class to have in a diversified portfolio. And so I think this audience knows the importance of fixed income investing, and particularly because it adds stability, regular return profile to a portfolio. Bonds tend to be, and there are occasions when they're not, but they tend to be less volatile than equities. So you don't get these wild price fluctuations that you could potentially see from growth equities. The pros of fixed income tend to be lower risk, predictable income, good capital preservation. And if you need an income, you can get a nice steady flow. Of course, there's always downside, right? So it is considered that fixed income assets or fixed income funds produce lower returns than stocks. Now, again, that hasn't always been the case. And in fact, I was looking at the JSE return, the All Share Index return for this year. We're up 12% so far. And but that's the best return we've had on the equity market since 2021. And, you know, we'll talk a bit more about which instruments to buy, but you could have bought government bonds, South African government bonds, which are considered risk-free. And I'm going to put risk-free in inverted commas and make the point that I don't think the South African government is going to default on their debt in the next 5 years. But you could have bought those at 10%. So absolute certainty of return and very low risk, as well as obviously volatility. But again, we'll talk briefly about that. The major kind of downside of bonds or fixed income investing, of course, is the credit risk, default, and the default risk. And then depending on where interest rates are going, and inflation could lead you to a number of issues. I often say that in fixed income, we don't manage for return. We actually manage the risk. We know exactly what the yield to maturity is going to be of an instrument when we purchase it. And where this falls out or where it becomes a problem in a fund is really two things. One, default, when you're not going to get your money back, and two, mark-to-market volatility. So if you're going to buy a bond and you're buying it at 10% and you know what your return's going to be, why does it change every year? Why do fixed income portfolios returns or total returns change every year? Well, because of these default and mark-to-market risk. And the default risk really we manage upfront. So we're fundamental analysts. We do our analysis upfront. We look at the issuer, we look at the balance sheet, we look at the cash flow and understand the company or the issuer's ability to repay the bond or to repay the money that we are lending them. Mark-to-market risk, that's a bit more difficult. We know, and it's weird, right? Because we all know that in fixed income, if you're talking about yields, the idea is to buy high and sell low to make a profit. Like that is just in everybody's mind, that's wrong. But we understand the impact of interest rates on the bond price. And so, yes, we do try to, where we can, manage that market volatility. The ones that we really watch out for, inflation risk, liquidity risk, again, that's one we manage right up front. We're not going to go into bonds where we don't think we can get out of them in short spaces of time, because we are in funds or we manage funds, and particularly the money market fund, Eugene, we manage it so that we can provide liquidity. And you know, our primary mandate is capital preservation. So this default risk is a huge issue for us. We need to eliminate, not manage, but actually eliminate that. Core risk is an interesting one. So the Nedbank bond I mentioned earlier on, talking around the BRI, the NGT 104, is a perpetual bond, but we think it will be called in January. So even though we bought, so you can buy it now at about 9.75 in the market, and thinking that that's the return or the yield that you're going to get on this instrument that you've bought, what happens now is that sometimes companies have issued bonds in high interest rate environments. And quite frankly, as interest rates come down, they don't really feel the need to be paying high yields or high interest rates to us who have loaned them effectively the money in fixed income. And so they may actually call or recall this bond when interest rates are lowered and then reissue bonds at a lower interest rate. What that means for us, unfortunately, is that we're now no longer going to get this nice 9.75 high yield. And when they reissue at a lower interest rate, then obviously that impacts negatively our yield to maturity or the yield in the fund. Credit risk, similar to default risk. But default risk obviously is like a ones and zeros, whereas credit risk is a spectrum. And so the possibility, well, maybe it's the probability, but probability is also ones and zeros, but the chances of a bond defaulting or an issuer defaulting on a bond is across a spectrum credit risk, right? And so we have the system where we rate bonds. We start off with the credit rating agencies. We do our own fundamental research, and then we rate the bond according to where we think it should be on this credit risk spectrum. And obviously, for higher credit risk bonds, we want them to pay us a higher yield. And kind of that's how we manage this yield, or we manage the generation of alpha, in that, especially in the money market fund, as I said, capital preservation is a primary mandate. So we won't go and take huge credit risk, but we still have a benchmark. We still need to return higher than bank returns. So we don't only go into the 100% safe government bonds, we also have credit exposure in this fund. Duration exposure, that's a little bit more technical. Yeah, I'm going to explain it anyway, very as simplistically as I can. And that's the risk of interest relative to the change in interest, or in the interest rate environment. So as you can see, kind of depending on how the interest rates move, depends on the price. Now, effectively, if you think about it, pretty much I can use that Nedbank example again. If we hold instruments that are fixed rate, and we know what return we're going to get, as interest rates go down, our benchmark decreases. But if we're in fixed, and if we're in floating rates, then the interest rate or the yield on our fund comes down. But if we're in fixed rate notes, then that yield stays the same, and chances are we can outperform. Duration risk, of course, is as these bonds that we hold in our portfolio mature, the reinvestment risk increases. So where are we going to buy instruments with the same yield of the ones that have matured? That's quite a tough one, actually, to manage. And what we've done, actually, at the beginning of the year already, we started moving our portfolio into fixed rate bonds, so that exactly we knew interest rates were going to start coming down. Granted, we all thought it was going to come down faster than expected. But so we're sitting in a nice portion of our fund in fixed rate notes, so that when interest rates come down, we will outperform our benchmark, and we will still be able to generate the higher yield than where the market is. I'm going to go through the slide very quickly. This is just Cartesian's kind of philosophy on how we manage funds. So we believe that we've got a benchmark, and the core is kind of very benchmark cognizant. And then the satellite, the little alpha generating positions, is what we use to beat this benchmark. We use duration, the yield curve positioning, to generate alpha. We're very strict about risk management and adherence to mandate. We've got a couple of mandates, across the risk spectrum. And so this fund, the money market fund, we're not trying to get you extraordinary returns. We're trying to beat bank deposits. And so it is unnecessary. There is no need for us to take additional risk. Besides, you don't pay us to take additional risk. So why would we give you, or put it in your portfolio, right? Why would we expose you to this additional risk? There's no need for that in this portfolio. We really are driven by fundamental analysis, the credit ratings, credit spreads, yield curve, even arbitrage opportunities and any market anomalies. And then we overlay this with our macroeconomic view. As I explained to you, we understood where interest rates were, what was happening with inflation globally and locally. And so we started moving our portfolio into fixed rate notes earlier this year. This is the performance of the Cartesian BCI Money Market Unit Trust. We've been managing this particular fund since March 2015. Not only have we consistently beat our benchmark, as you can see, the blue line is the fund, the gray line is the benchmark. But we're very proud of the fact that we are regularly in top quartile. In fact, it's a bit of a drama in this office when we fall out of top quartile. And you know how it is, right? Like, not every single month is the same. And sometimes there are adjustments, and sometimes when you rebalance your portfolio, you kind of, there's a little blip in returns, but we've managed to consistently perform and return well above benchmark, which in itself is above bank deposit rates. The fund is Reg 28 and Board Notice 90 compliant, so very easy to use. I did mention that we also have a fixed income hedge fund. And here the strategies we tend to use: portable alpha, we use some derivatives, futures and options, some repo, currencies and commodities. Not my favorite. They're so volatile. You know, we've done three currency trades this year. 2 of them went exceptionally well. 1 didn't, and that's because the rand was so strong in like post the elections and in recent times, and we were expecting the rand to weaken or the dollar to strengthen, and that hasn't happened, as you are well aware. So let's be honest, a fixed income presentation is just not a fixed income presentation without a macro overview. So I'm just going to take a few minutes to give you my view on what we're thinking about the world. So there are so many stories about China and where they are at the moment. And we recently did a research piece called China and Western Skepticism. And I've put on the slide the old adage: America innovates, China replicates, and Europe regulates. Now, it's absolutely true. I think America still does innovate, although China's catching up very quickly. Europe definitely regulates, and they're expensive for it. But does China really still replicate? Now, there's a great story. I think it was in the 80s or maybe even the 70s. So probably my favorite story. China decided they wanted to build a shoe or a tacky manufacturing factory in China. And I do think it was the 70s. So the Chinese sent over a delegation, some technicians, for a tour of the Nike factory with the distinct charge of replicating this factory. They copied the factory so well that there was an arm or a crane arm over the production belt, which was initially used to lift boxes from the belt onto a table where staff would manually seal the boxes. However, by the time the Chinese visited this factory, the Americans had already built an automated sealing function at the end of the manufacturing or production line, but they hadn't yet had a chance to remove this arm, as you can imagine, that picks up the boxes, which of course now was defunct. And the Chinese went and totally copied everything right down to this defunct arm. But I don't think that's true anymore. And my view is, as Westerners, we like predictability. We want to know that every 2 months we've got an MPC or US Fed meeting, that the Fed or the members of the committee have given us some indication of where interest rates are going, so that we know what to put into the market and how to read the market and so forth. We also don't like them just throwing things into the market that are unexpected. Whereas the Chinese, and I get asked this question so often, is the Chinese stimulus that they are doing currently enough? My view on that is, who cares? Because if it's not enough, the Chinese are not going to wait or give themselves names like Helicopter Ben, or, you know, criticize the Fed or Treasury for doing what they do, or making decisions that they haven't prepared the market for. Look, make no mistake, I love I'm Western. I'm a Western capitalist, and I love my freedoms, and I love the predictability of the market. But the Chinese have self-imposed a 5% GDP growth target. And I don't think that they will want to lose face by not meeting this target. And so they will do whatever they will do to get to where they want to. I tell another story, by the way, very analogous, of China gets what China wants. So in 2002, 2004, China decided they wanted to come out into the world, kind of a globalization. They wanted to get onto the world stage. And how were they going to do this? And this, you'll remember, is about the time of kind of the Naspers 10 cent, you know, the big issue around Naspers investing in 10 cent and how much they had. and whether or not Tencent was worth this big investment. And eventually it was, but there were issues around it. Anyway, so China decides they want to enter the world stage. And they decide they're going to do this by bidding for the 2008 Summer Olympics. Not only did they bid, but they actually got the Summer Olympics. So there they are, hosts of the 2008 Summer Olympics. But at that stage, the Olympics was very much dominated by Americans and Russian. And you'll remember those Russian gymnasts, right? Nadia Comaneci must ring a bell or two. And what China did was they said, well, now we're hosting the Summer Olympics, surely we need to perform. They threw all their resources at the athletes to the point where, for the first time in history, China won the most gold medals at an Olympic Games. So my point, China gets what China wants. So how's this for a slide? The world's biggest solar farm goes live in China and can power an entire country for a year. Look, I didn't write that heading, and I certainly would have, because there must be questions around the size of the country that it can power. But this solar plant, or this farm, I should say, went live on the 5th of June of this year. 5 gigawatt complex occupies roughly the same area as New York City and puts the country at the forefront of energy revolution. And sorry, you're going to have to forgive me, because I'm going to have to look down now and not into my screen at you and read to you exactly what this entails, or what this example shows us. Because China now dominates the green energy supply chain, producing 60% of the world's wind turbines, 75% of solar panels, and 85% of lithium batteries. In addition, it has established such significant influence over African nations that they supply key minerals like cobalt, copper, lithium, and zinc. Over the past 20 years, China has developed significant processing and refining capabilities for these minerals, controlling over 40% of global processing capacity. And so it's interesting to me that whenever China doesn't meet its, can I just point out, self-imposed, make the point, self-imposed 5% GDP growth target, the Western world goes crazy. We sell down their shares. We're upset because where are we going to get the global growth? Where's economic growth going to come from? And if China's not growing, well, and then you'll see that the market comes off a little bit, and then China throws some more stimulus at it, and it bounces back. And so, yeah, so the question, is China doing enough to stimulate its economy? I tell you, if our politicians would self-impose a 2 to 2.5% economic growth target, I would be a very happy woman. And the question, of course, is we have the Reserve Bank managing interest rates, and I don't know if we'll have enough time to talk about this, but why don't we have politicians with economic growth targets? Yeah, I paused for effect. Right, let's talk about the US, right? Because there's another big one. So is the US going to go into recession or soft landing? And we've looked at all the leading economic indicators, or even just general economic indicators. And I won't lie, there a lot of them show that the US should go into recession. We don't believe it. Our base case is for the US to achieve a soft landing, or for growth to slow, but remain above the long-run Fed forward estimate of 1.8% per annum. We firmly believe that the Powell put is still very much in play, and most likely to give a nice little boost to equity markets. But the results may be kind of short-term flash outflow from US bonds and emerging markets because of this, right? So what you're looking at on the screen at the moment is a graph of the SARM rule. Now, I don't remember studying the SARM rule when I was studying, but it's become quite popular of late. And what it says is that the US economy will go into recession when the SARM rule is triggered. And the SARM rule is triggered when the unemployment number increases by more than 0.5 above the lowest 12-month unemployment, or higher, sorry, 12-month unemployment number. And this has recently happened, as you can see right at the bottom right-hand side of your screen in red. The SARM rule has been triggered with a 0.57 reading. Although I want to point out that even Claudia Sahm, who's the Fed economist, very clever woman, even she said, maybe this time is different. So we're believing her that this time is different. We don't think the US will go into recession. But another thing which we must talk about, and in fact, I only added this slide to my presentation a few minutes before we went online, because one of my analysts was showing me that this graph. And what this graph is basically is the orange line is Donald Trump's odds of winning the election. The blue line is the US 10-year yield. It's a fascinating chart by a guy called James Bianco. Yeah, and so the chart starts pretty much the day Biden dropped out. And you can see that correlation is a little bit scary just if you eyeball it. So as Trump's odds of winning get better, that's the orange line, the US 10-year Treasury yield increases. So clearly the market believes that Trump policies, especially his trade restrictions, will be inflationary. And I guess the question is, you know, if this orange line or this orange series, which is the chance of Trump winning, gets to 100, what is going to happen to US Treasury yields, or the 10-year yield, at least for this chart? And then very quickly on South Africa, you know, South Africa's economy started the year on the back foot with the first quarter negative growth of 0.1%. This contraction really pointed out the challenges that South Africa is facing, which almost led to a technical recession. But I think well, I don't think I know, you know, the South Africa's fortunes certainly turned on the 17th of June when they announced the government of national unity. And in my view, I understand that lack of load shedding. Michelle's doing a great job at Transnet. All these are really great green shoots, but I can't see that South Africa is completely going to turn this around. We need structural change. And I'm going to repeat myself here, but wouldn't it be great if the politicians could self-impose an economic growth target for the country? So this is the 5-year yield chart of the South African government bond. So the green shape outlines the nice rally we've had in the bonds. So don't forget this, we're talking about yields. So as yields come down, the price has rallied. So that's good for us. You know, this thing about buy high and sell low to make a profit. There you go. That's kind of showing you that. The red little box there is the little correction we've had in the last few weeks, which really takes us to levels we were in April 2022, if I'm correct. Let me just check on my chart. That's right. When actually we should easily be able to reach levels around 9.5% yields. We're on, I mean, what we're showing you there's basically 10% yield on the 10-year. And so I think the rally should continue. And I guess I should also mention at this stage, because we're talking about sentiment, and sentiment, let's be honest, does drive the market. So it's worth mentioning that the SA 5-year CDS, which is kind of the insurance that investors take out on the country defaulting, is currently trading quite comfortably below the 200 level, which gives me confidence that the market believes, and so do I, that South African government is not going to default on its debt. Now, this is the rand. This is a completely different story. This is the rand against King dollar. I'm not sure what to say about this. You know, we don't predict the currency. We think it's impossible to, definitely more volatile. But the reality is that this is not simply a function of South Africa's performance, but also the currency that it's paired against, right? I do think positive sentiment is what's holding the currency at these levels. But again, we need structural change. So I know this is very naughty of me, but I do feel like at the moment, South Africa is very much land of the free and home of the brave. We're all so positive on where South Africa is and feeling strong about it. Yeah, so I'll just leave it there, then, shall I?
Anthea, thank you very much for that. You definitely finished there on a high note. You land of the free, but definitely the brave. I would agree to that. Maybe just quickly, if we can work backwards and just looking at the macros, a couple of last slides you showed there. SA bond yields increasing in the past couple of weeks. Is that because of overall inflationary fears in the world again? People saying, but we could see inflation coming back in again, or what is happening there?
Yeah, that's exactly right. So suddenly, so when the Fed cut by 50 basis points, and I'm not saying that the Fed leads South Africa's thought process on whether or not we should cut interest rates. That's a whole nother discussion, Eugene. But so when the Fed cut by 50 basis points, there's no doubt that Powell, if you want to read into it, he kind of admitted that maybe they'd waited too long before they started cutting. And so off the market goes, because now they're expecting another rate cut and we're seeing things changing. And then I think, like, the US economy is still very strong, and there's actually probably no need for the US to cut interest rates the way they need to. So that's one factor. Then our CPI is coming out later today. We're expecting 3.8%, which takes us well below our target of 4.5%. And so perhaps we don't need another rate cut. And so where does that leave the consumer? Where does that leave companies that need to fund if interest rates are not coming down as quickly as we thought they were? And I think that's kind of given the market a bit of a scare. But also, as you saw, the market rallied so hard. I suspect that quite a few people took profits and kind of going, okay, well, I'm okay to sit on cash for a while and see where this market is going. So I think that's what happened in the market sell-off in South Africa.
And I think that brings me to my next point, and hence the reason for money market funds. There's definitely a space in portfolios for that. If you do want to take profit, you want to sit on the side a little bit, maybe something worth considering. Just going back to macro, the US again, the SARM rule, I found that very, very interesting. I always get a bit nervous if people say, but it might be different this time.
You heard it in my voice, right, Eugene?
Yeah, exactly. It's different this time. It's like I get the heebie-jeebies. But I mean, all risks are definitely not off the table. There's still fears well, we can see it in the US, job demand numbers are definitely declining. So we might see a job demand recession in the US. So do you think we can still see a bit of a recession coming through, or far more muted growth in the US taking place?
I think you've hit on the issue, if you want to call it that Claudia Sahm has put forward. So the unemployment rate increasing depends on a number of things, right? And so really it's because there would be a decrease in labor demand, not because of an oversupply in labor, as we have seen kind of recently, with all the immigration and that sort of thing. Does that mean, yeah, so we have looked at the other economic indicators, and even then we're still quite positive that the US economy is strong enough to avoid a recession. And I wish I had more slides for you, Eugene, but I'm trying to think of whether I can quickly pull them up, but I don't think I can. So I'm just going to have to talk you through it. Of course, the risks are still on the table. And I think that's why also the Fed has been so cautious about cutting interest rates and kind of managing this position that they're in. It really has been probably the most precarious position that the Fed has been in for, I would say, probably 2 decades.
Yeah, and I mean we see it all the time, especially now with all the reporting on the U.S. elections. U.S. consumers really starting to feel inflation. I mean, it's really starting to bite now. And you know, I think people sometimes think about inflation uh, maybe the wrong way, because inflation, although it's decreasing the numbers, it doesn't mean prices are falling. It's just increasing at a slower rate, and it's already expensive. You know, so well, we wait and see how it's going to impact on consumers globally. I want to get back to your money market fund. I mean, a lot of moving parts of the money market fund. Traditionally, I know we all taught, you know, money market funds consist of short-term entities and BAs. You know, there's not a hell of a lot to it, but you explain exactly the opposite. So it's got a lot to do with risk management and how you maintain a high yield, especially in a rate cutting cycle. So I found it very interesting that you used fixed rate notes in a money market fund, you know, in a cutting cycle to try and lock in those higher rates. But what is the maximum average duration that money market fund can go?
So Eugene, you're absolutely spot on. The mandate says that we're only allowed to buy to a maximum maturity of 13 months, and we're not allowed to exceed our weighted average maturity of 120 days. We're around 99 days at the moment, so we've still got some space to play in that duration. But as interest rates were rising, so kind of 2 years ago in this money market fund, we really used the extended duration to get the yield pickup. And then, as I mentioned previously, that in January, well, early this year, we started moving into fixed rate notes because we were expecting rates to decrease. And I won't lie to you, I think everyone's kind of cottoned onto that because the market, there is a dearth of fixed rate notes to invest in the market because everyone is expecting these interest rates to come down. We're on about I think it's about 42% of fixed rate notes in the fund at the moment. And then, of course, the floating rate notes, well, you know, you can only do so much. And also, kind of in the last 2 weeks, I suppose, with this change in interest rate cutting cycle thought process, it's not an absolute no-brainer that we're going to get rate cuts and what's going to happen. And especially, Eugene, with last week, you would have heard Lesetja Kganyago talking about lower inflation target. Now, it is his final term. I think he would love the legacy of South African inflation being at 3.5%. You know, he's the guy who took it from whatever it was, floating to fixed between or targeted in the band of 3 to 6, and then saying, no, actually, we want 4.5. And in his view, and he's not wrong, I guess, it's an opinion thing, he did it with very little extra cost to the economy or to the consumer. I'm not sure about that, but, you know, and maybe the high inflation wasn't necessarily his fault, but so he can say that. But if he now changes the target to 3.5%, does that mean we have a higher terminal interest rate to bring it down? I think it can only be left to be seen. You know, with inflation, it predicted to be 3.8% this morning, come in at 3.8% this morning. It gives him scope to cut interest rates, but with a lower target of 3.5%, maybe he won't be in such a hurry, and maybe he'll think that 3.8% is a flash in the pan, and next month it'll be 4 or 4.5, or maybe even 5 again. So I think this is it's an interesting time for us.
I found it very, very interesting how you manage these things in the money market fund. And I mean, it does show in your numbers of late as well, even relative to the peer group, you know, so strong performance there. Definitely a money market fund worth considering if you do have some or want some dry powder in client portfolios, or clients looking for steady income in an environment where rates are probably going to be higher for a little bit longer. Anthea, this has been extremely insightful indeed. I really appreciate your time this morning. Bit of insight into your business as well. We can find the money market fund on most of the large platforms. All clients can even invest directly into the fund as well. Anthea, thank you so much again. Great insights this morning. to our audience out there, you know how it works. If you want more information on the fund or a little bit more about the business in Anthea, more than welcome. Open door policy, contact directly, and we'll get you in touch with Anthea. Anthea, from our side, thank you so much for your time this morning. It's been absolutely great to have you with us.
Thank you very much, Eugene. Have a good day.
Likewise, the audience out there, quick reminder, next week, Wednesday, 30 October, we're doing a special session or special edition on hedge funds and unveiling what is happening in the hedge fund world, how does it work for retail investors. And we've got a very good lineup of presenters, experts in their field on hedge funds from 9 o'clock in the morning until 11. It should prove to be very insightful indeed. Thank you all for joining, your continued support. We always remain grateful, and we'll see you next week, Wednesday, 30 October. Thank you so much.